The global financial system is engaged in a high-stakes monetary experiment, and Bitcoin, currently trading at $94,727, is poised to be its biggest beneficiary. Raoul, the former Goldman Sachs strategist turned crypto oracle, has unveiled a compelling case. The deliberate devaluation of the US dollar could propel Bitcoin into uncharted territory in coming months. In his latest analysis, shared with 1.1 million followers on X, Pal exposes what institutional investors already know but rarely discuss. Global policymakers are orchestrating a controlled decline of the dollar to manage the $36 trillion US debt burden. This isn't conspiracy theory, it's balance sheet math, Pal asserts, noting that with Bitcoin holding firm at $94,727, the market is already pricing in this tectonic monetary shift. The mechanics are straightforward, yet profound. As the Fed potentially pivots to rate cuts amid recession signals, the resulting liquidity surge historically correlates with Bitcoin outperformance. Pal's proprietary models reveal an 87% correlation between global money supply and Bitcoin prices, a relationship that propelled Bitcoin's 2020 rally. Today, with BTC at $94,727, we're seeing history repeat as institutional investors allocate to crypto as a hedge against currency debasement. What makes this cycle different? The scale. Pal's liquidity tracking shows money supply growth accelerating just as Bitcoin consolidates near 94,813, a textbook setup for breakout momentum. The 12-week lag between liquidity injections and Bitcoin price action suggests we're entering the sweet spot, Pal notes, pointing to Q4 2025 as a potential inflection point. For investors, the implications are clear. With traditional assets faltering under inflation and Bitcoin demonstrating remarkable stability at $94,727, the case for crypto allocation has never been stronger. As Pal concludes, when the world is deliberately devaluing its reserve currency, you want assets with absolute scarcity. That's Bitcoin's $94,727 price tag isn't resistance, it's a launching pad. The message is clear: watch the dollar, follow the liquidity, and prepare for what could be Bitcoin's most consequential rally yet. In a world where trust in fiat currencies is eroding, Bitcoin stands ready as the alternative, and the clock is ticking. While Raoul makes a compelling case for Bitcoin's rise amid a weakening dollar, Lyn Alden offers a fascinating counterpoint. The real game changer isn't just monetary policy. It's the end of a 150-year technological mismatch.
And so I kind of separate the financial history into kind of three main eras. So the first era was pre-telegraph. That's when everything was analog. And so there were monetary technologies, things like coinage, things like paper and the printing press. We don't really think of them as technologies today, but at the time they certainly were these new technologies that allowed basically forms of ownership and money to move around quicker and transactions to move around quicker. But once they invented the telegraphs, that was the 1830s, and then by the 1860s, we had cross-Atlantic cables, cross-continental cables, and you could talk almost instantly or send low bandwidth signals almost instantly around the world. And that means you could do transactions almost instantly around the world. And the way that I describe the problem is that opened up a really big mismatch between transaction speeds, which could now just go around the speed of light almost, and settlement speeds, which at the time were still physical gold and other, physical valuables. And the main way that they bridged that gap was to have a big centralized ledger. So either big commercial banks, or in many cases, a central bank that all the commercial banks build on top of. And that becomes a trusted layer that everybody has to use to bridge between settlements and transactions. And whenever there's a really big centralized honeypot, it's prone to manipulation. It's prone to people misusing it for various reasons and kind of breaking that trust. And the reason I look at that through that technological lens is because I think for the first time in a very long time, that gap is closed, because Bitcoin, it represents multiple things, but in this context, it represents the invention of fast settlements. So after basically a century and a half, we finally had the settlement side catch up to the transaction side. And that, of course, took a lot more bandwidth, a lot more inventions that just had to be created over the course of that period of time. And so I would say money's been broken. It's partially because of individuals making decisions. So we can point to, the creation of this central bank or this politician making this decision at this time. Those are all true. But I think the structural underlying problem for why it's basically broken in every single country, and it's been broken for a very long time, is because we've kind of lived through this technological mismatch. And that's made it very hard. Basically, all the incentives in front of politicians and central bankers and policymakers in general erred toward making it very easy for them to break the trust and create problems. So structural inflation, the underlying cause is growth in the money supply on a sustained basis. Now, you can have temporary causes of inflation, of price inflation, things like, for example, a war or a shortage or other, basically anything that harms productivity can make prices go up temporarily in a certain area. They will generally, if the money supply growth itself is not the issue, those prices will come down in time, and or they will lower the prices of something else that people aren't buying because they have to prioritize buying this thing that has gone up in price, if it's something core like food or shelter. But in order to get sustained, persistent price increases like we see today and for a very long time, it requires that the money supply itself is increasing. That's an axiom that's true everywhere. And that primarily hits us in one of two ways. The way we normally think of it is consumer prices go up, or a typical basket of what a person might buy in a given year, that basket is increasing. And they're all happening at different rates. I mean, things like hospital services might be going up faster than the official inflation rates, while things like electronics might actually still be deflating because they're getting more productive even faster than the money supply is growing. And so they actually have a negative inflation rate in some cases. And the mix of all that together is we find that the average price of living a year of our lives, much like last year, is higher, which means that then Americans have to go out and try to get a raise, try to kind of keep up with that.
Alden slices financial history into 3 eras, revealing a critical flaw. Since the telegraph's invention in the 1800s, transactions moved at light speed, but settlements lumbered behind, reliant on gold and centralized ledgers. This gap birthed today's fragile system, where central banks, commercial banks, and politicians exploit the lag, manipulating money and breaking trust. However, with Bitcoin, settlements finally match transaction speed, closing that centuries-old gap. This isn't just about inflation hedges or liquidity surges. It's about fixing money's structural brokenness. So, while Powell watches the dollar's decline, Alden's lens suggests something bigger. Bitcoin at $94,727 isn't just reacting to Fed policy, it's pioneering a new monetary era. The dollar's debasement may fuel the fire, but the real revolution, technology just healed money's oldest wound.
The other way that it can manifest is it can show up in asset price inflation, which is normally not very captured in consumer prices. But basically, when you have a period of rapid money supply growth, but also pretty high productivity growth, so if the economy is doing a pretty good job of keeping energy well supplied and other goods and services flowing pretty readily, then not all of that money supply growth is going to necessarily show up in prices at the same rate. And a lot of that surplus will show up in things like equity prices, housing prices, gold going up and kind of capturing some of that, maybe the modern era of Bitcoin now. But looking at history, we basically any of these more monetary type of assets that are primarily owned by the wealthier, the upper middle class and the middle class, those assets tend to capture a lot of that growth. But then that can make it harder for new entrants to want to buy those assets, which is particularly relevant for housing. So at the end of the day, it all comes back down to money supply growth, because that's a necessary part of, if we see inflation like on a persistent basis, it has to be because the money supply itself is also growing. I think when we look at a couple key things like house price inflation, as well as other big expenses like healthcare inflation, these things have generally been above trend compared to what we think of as inflation, CPI. And those are some of the biggest expenses that people have. And so back in like the 70s, for example, interest rates were quite high. And so in many cases, saving in bonds, especially by the time they got to the 80s, was considered more attractive. And you wouldn't necessarily want to go out and buy a house just for savings if you're going to pay a mortgage rate of like 10% or higher in many cases. So the average house price was lower, and people primarily looked at them as a utility thing. You need shelter, so you buy a house. As interest rates came structurally down, and as we went through multiple decades of persistent currency debasement and people realizing that if the money's weak, they have to save in other things. They have to monetize other scarcer assets if they want to preserve their purchasing power. One of the key things they go into is real estate. That's in addition to things like equities or gold or other financial assets, but real estate's obviously a very large and popular one. And so people can buy second homes and leave them empty. People can, do all sorts of things, and they're willing to pay pretty high prices because if you're wealthy and you can get a 3% mortgage while money supply is historically growing at 7% a year, many of them will pay up quite a bit for a house and then price out more price sensitive buyers. And so that has been a, pretty persistent issue against the middle class and overall household formation and key metrics like how many hours of work it takes to afford a house. And some people will push back on that and say, well, houses have gotten bigger on average. Then the counter pushback is that they've also in many ways gotten lower quality per square foot. So if you knock on the wall of your new construction today, it's going to sound like balsa wood compared to what a new construction would have been like years ago. And of course, you've gotten better at engineering, so some things work better, of course, but on average, it just takes more work to afford a similar size and quality of house than it did some decades ago, and therefore it often takes two incomes, and people can feel like they're having trouble getting ahead.
The greatest wealth transfer of our generation isn't happening on Wall Street, it's happening in your neighborhood. While everyone watches consumer prices, the real inflation crisis has been silently jacking up home values and stock portfolios, locking ordinary people out of wealth-building opportunities. Remember when one income could buy a quality home? Today's inflated housing market demands 2 salaries for subpar construction, all while the wealthy park cash in assets using cheap debt. This rigged system forces hard workers to run faster, just to stay in place. Bitcoin has flipped the script on traditional finance with its unchangeable 21 million supply cap. No printing presses, no backroom deals. Unlike real estate or stocks that favor those with connections and capital, Bitcoin gives everyone equal access to sound money. It's the first truly democratic hedge against an economic system designed to benefit asset owners at everyone else's expense. As central banks continue devaluing currencies, Bitcoin stands as both shield and sword, protecting savings while offering a fair shot at financial freedom. The coming decade won't just be about cryptocurrency growth. It'll be about reclaiming economic sovereignty from a broken system that's been quietly picking pockets for generations. Bitcoin isn't just an investment, it's the working class's revenge against financial repression. The perfect storm propelling Bitcoin to $100,000 and beyond. The financial world stands at the precipice of a monetary revolution, with Bitcoin positioned squarely at its epicenter. As the pioneering cryptocurrency flirts with the $95,000 mark, a convergence of technical indicators, on-chain metrics, macroeconomic forces, and structural shifts in global finance suggest we're witnessing the formation of a perfect storm, one that could catapult Bitcoin past the psychologically crucial $100,000 barrier in the coming weeks. This isn't mere speculation, it's a carefully unfolding scenario where multiple independent factors align to create what may become Bitcoin's most explosive price movement yet. On the technical front, Bitcoin's charts are painting an extraordinarily bullish picture across all time frames. The daily chart reveals a textbook double bottom formation, one of the most reliable reversal patterns in technical analysis, which completed its breakout above the 87,643 neckline resistance. This pattern projects a measured move targeting $100,575, a prediction strengthened by supportive momentum indicators. The Relative Strength Index, RSI, while in bullish territory, still shows room to run before entering overbought conditions that might suggest exhaustion. Perhaps more importantly, Bitcoin has successfully flipped both its 50-day and 200-day exponential moving averages from resistance to support, creating a sturdy foundation for the next leg upward. These technical signals gain further confirmation when we examine shorter timeframes. The hourly chart shows Bitcoin consolidating in a bull pennant formation following its recent surge, a continuation pattern that typically resolves in the direction of the preceding trend. This coiling action represents a temporary equilibrium between buyers and sellers that frequently precedes explosive moves. The pattern's technical target sits at $100,900, and its development after such a steep initial rally increases the probability of another significant upward movement. Zooming out to the 3-day chart reveals yet another compelling formation, a completed falling wedge breakout, with its upper trendline resistance decisively broken near $94,000. This particular pattern carries a projected target of $102,270 and gains additional credibility from the notable volume surge that accompanied its breakout. The convergence of these multiple technical patterns across different timeframes creates a rare and powerful setup where various indicators mutually reinforce each other's bullish implications. Beneath these price movements, the underlying market mechanics tell an equally compelling story. Liquidation heat maps reveal an extraordinarily dense cluster of short positions clustered around the $100,000 level. This concentration creates what traders refer to as a liquidity magnet, a price zone where the market structure itself may actively pull prices higher as over-leveraged short positions become forced buyers when their positions are liquidated. The potential for a cascading short squeeze adds fuel to the technical breakout scenario, creating a self-reinforcing cycle where rising prices trigger more liquidations, which in turn drive prices higher still. This phenomenon has precedent in Bitcoin's history, where key psychological levels have frequently acted as catalysts for accelerated moves as they attract both speculative interest and defensive positioning from market participants. The on-chain data provides perhaps the most objective confirmation of Bitcoin's strengthening position. Glassnode metrics show that 87.3% of Bitcoin's circulating supply is currently held at a profit, up significantly from 82.7% during March's consolidation. This increase demonstrates that a meaningful portion of Bitcoin changed hands at lower levels during recent corrections, representing healthy accumulation by new buyers rather than distribution by long-term holders. Historically, when the percentage of supply and profit exceeds 90% for sustained periods, the market enters what might be termed a euphoric phase, suggesting there remains room for expansion before reaching peak exuberance. Even more telling is the behavior of long-term holders, whose supply percentage remains near all-time highs despite Bitcoin's impressive rally. This indicates that the market isn't yet overheated from a distribution standpoint, with committed investors continuing to hold through price appreciation rather than taking profits en masse. Such holder behavior typically characterizes the middle stages of bull markets rather than their speculative peaks. What makes this cycle fundamentally different from previous bull runs is the maturation of Bitcoin's ecosystem and its integration into traditional finance. The approval of spot Bitcoin ETFs created a seamless on-ramp for institutional capital, while growing corporate adoption as a treasury asset demonstrates real-world utility beyond speculation. Macroeconomic instability, from currency devaluation to banking sector fragility, provides the perfect backdrop for Bitcoin's value proposition as an inflation-resistant, decentralized asset. Technological advancements in Layer 2 solutions and improved regulatory clarity have reduced volatility and smoothed adoption curves. As Bitcoin consolidates near $95,000, several potential catalysts could trigger the final push past $100,000. Federal Reserve policy shifts toward rate cuts would unleash fresh liquidity into risk assets. Continued inflows into Bitcoin ETFs would sustain buying pressure. The psychological importance of the $100,000 level itself may attract speculative interest and media attention that fuels a self-reinforcing rally. Perhaps most compelling is the simple fact that all the pieces are in place: the technical setups, the on-chain accumulation, the macroeconomic backdrop, and the structural demand drivers all point toward higher prices. The road to $100,000 isn't merely about a price milestone. It represents a symbolic threshold that could fundamentally alter mainstream perception of Bitcoin's role in global finance. Crossing this barrier would likely trigger a wave of institutional FOMO, fear of missing out, media coverage, and public awareness that draws even more capital into the space. While short-term volatility remains inevitable, the convergence of factors described here creates one of the most compelling bullish setups in Bitcoin's history. Whether the peak comes at $100,000, $150,000, or beyond, the coming months may well redefine cryptocurrency's place in the global financial order and mark a new chapter in the evolution of money itself. Thanks for watching. Please share this video, hit the like button, subscribe, and turn on your notification bell. See you in our next video.